Buying a home in Florida in 2026 feels like capturing a piece of paradise. The sun, the coast, the lifestyle, it's easy to see the appeal. And this year, buyers have more leverage. The baseline conforming loan limit has increased, giving you standard purchasing power up to $832,750. If you're looking in a high-cost area like Monroe County, that limit stretches even further, capping out at $990,150. With that kind of borrowing power, it's easy to fixate entirely on saving up your down payment and hunting for the lowest possible interest rate. But that narrow focus hides a costly reality. To actually get the keys, you'll need an additional 2 to 5% of the total purchase price just to cover closing costs. This chart shows exactly how those costs stack up on a typical $400,000 home purchase. You start with your down payment, but then heavy state fees like documentary stamps, intangible taxes, title costs, and upfront mortgage insurance drop right on top. Suddenly, your standard down payment might only represent half the actual cash you need at the closing table. Anywhere in the country, buying a house comes with standard closing costs. You expect to pay the appraisal, the home inspection, and the lender's origination fees. But Florida operates on its own set of rules. The state enforces a unique ecosystem of mandated expenses that you won't find on a standard national checklist. We're going to break down 3 specific hurdles: documentary stamps, intangible taxes, and a fragmented county-by-county system for title insurance. Lenders cannot waive these costs to earn your business. These are state-mandated taxes and local customs that apply regardless of which company processes your application. Surviving the Florida real estate market means you have to choose a mortgage vehicle specifically designed to absorb these taxes without draining your bank account. The first unavoidable hurdle for buyers is the Florida documentary stamp tax levied directly on your mortgage. This scorecard breaks down the state taxes. For buyers, the state charges 35 cents for every $100 borrowed. Right below, the non-recurring intangible tax takes a flat 0.2% of the loan. Sellers don't escape. When transferring the deed, they are hit with a documentary stamp tax of 70 cents per $100. This tax takes a visible bite out of their net profit. Because sellers are already losing thousands to the state, they're usually much less willing to offer you closing cost credits during negotiations. Before the loan even begins, these mandatory taxes drain thousands in liquidity from both sides, shifting the financial outcome of the transaction. The expenses get even more localized when it comes to the owner's title insurance policy. In Florida, who pays this bill depends entirely on where you buy. Look at this map. In Miami-Dade, Broward, Sarasota, or Collier counties, local custom dictates the buyer pays for title insurance. That adds roughly $1,000 to $2,500 to your closing cash. Move north to Palm Beach, or almost anywhere else, and the map flips. In these counties, the seller typically pays. But that relief comes with a catch. When the seller pays, they get to choose the title company. That removes your ability to shop around and control the ancillary settlement fees. Crossing a single county line in Florida can instantly require you to save an extra few $1,000s just to reach the closing table. To navigate these harsh upfront costs, buyers generally rely on one of 2 mortgage vehicles, FHA or conventional loans. The FHA loan is highly appealing at first glance. It allows for credit scores as low as 580 and requires just a 3.5% down payment. But the FHA program has a massive hidden trade-off, a mandatory upfront mortgage insurance premium of 1.75%. This comparison matrix shows the damage. On a $300,000 loan, that upfront premium drops a heavy $5,250 block onto your balance sheet. Stacking Florida's doc stamps and taxes on top wipes out the cash saved from a lower down payment. The conventional loan requires a 620 credit score, but its upfront premium stays locked at 0. While you still pay monthly private mortgage insurance if you put down less than 20%, that monthly charge automatically drops off once you build enough equity. An FHA loan looks cheaper on a national billboard, but in Florida, the conventional loan is significantly more efficient at preserving your cash against the state's heavy closing costs. Making the right choice comes down to matching your specific financial profile to the correct loan strategy. This quadrant chart plots your options. With a high credit score and moderate to high cash reserves, you land in the top right with the conventional loan. Avoiding the FHA upfront premium preserves the exact cash you need for Florida state taxes. With a lower credit score and limited cash, you land in the bottom left with the FHA loan. Here, your strategy depends on negotiation. FHA guidelines let you ask the seller for up to 6% in concessions to offset those upfront markers. A 6% concession covers both the Florida state taxes and the FHA upfront fee. Even if you have to offer the full asking price to get the deal accepted, your limited cash stays safely in your bank account. Florida's unique tax codes and fragmented title laws mean that standard, generalized national mortgage advice simply does not apply here. Before you finalize how much you plan to put down, you have to aggressively factor in that 2 to 5% closing cost reality. You also need to verify exactly who pays for title insurance in your specific target county before submitting any formal offer. Winning in Florida depends on choosing the precise loan structure designed to withstand the state's heavy upfront toll, rather than simply chasing low interest rates.